Greetings, everyone. We're now at tutorial sheet 8, question 3. Project X is very risky and has an NPV of $3 million. Project Y is very safe and has an NPV of $2.5 million. Assume that the two projects are mutually exclusive and that each of the NPV calculations take into account the risk of the respective projects. Should the firm accept Project X or Project Y? Explain. I now hand over to Mario Scarlett and Tanis White, who will take us through the question.
Good evening, everyone. I am Tanis and
I am Mario Scarlett.
And we will be doing question 3 and tutorial 8 for this evening. So the question reads, Project X is very risky and has a net present value of 3 million. Project Y is very safe and has a net present value of 2.5 million. Assume that the two projects are mutually exclusive and that each of the NPV calculation takes into account the risks of the respective projects. Should the firm accept Project X or Project Y? Explain.
All right, so pretty much the conditions for this question starts off with, so because the projects are mutually exclusive, only one of the two can be accepted, of course, and we'll be using the net present value decision rule, which states that the project with the higher NPV should be chosen.
Okay, so we came up with this decision that the firm should accept Project X because it fits the condition, making it the correct project to choose with the NPV of 3 million in comparison to Project Y with 2.5 million. And also, since they both take into consideration the risk, so we will work we believe that the Project X is the right fit for this firm.
All right, thank you. And that will be all from myself, Mario, and Tanis.
Okay, thank you, Mario. Thank you, Tanis. We're now going to move on to De Niro Fuller and Javon Bourne.
No problem.
Good night. We'll be the question 3. My name is Javon Bourne, and I'll be doing this question with De Niro Fuller. Yes. Project X is very risky and has an NPV of 3 million. Project Y is very safe and has an NPV of 2.5 million. Assume that the two projects are mutually exclusive and that each of the NPV calculations take into account the risk of the respective projects. Should the firm accept Project X or Project Y? Explain. All right, so in deciding which project the firm should select, whether Project X or Project Y, we should consider NPV decision rule. NPV decision rule indicated that mutually exclusive project having the highest positive NPV will rank first to second. Always accept the highest NPV project if there are only two projects.
NPV decision rule also states to invest in projects that have a positive present value. Once the NPV is greater than 0, you invest in this project. Once the NPV is less than 0, you do not invest. As stated in the question, the Project X and Project Y are mutually exclusive. Mutually exclusive are projects that the cash flow of one can be adversely impacted by the acceptance of the other. For example, if the two projects are mutually exclusive, then only one can be accepted. In question 3, it says the Project X has an NPV equal 3 million and Project Y has an NPV of 2.5. We should invest in Project X because this project NPV is greater or higher between the two projects.
Thank you. Now that's enough for question.
Thank you, De Niro and Javon. We now move over to Vanessa Williams and Sarah Salmon.
Good day, everyone. This is tutorial sheet number 8, question number 3, done by Sarah Salmon and Vanessa Williams. The question we got was, Project X is very risky and has a NPV of 3 million. Project Y is very safe and has a NPV of 2.5 million. Assume that the two projects are mutually exclusive and that each of the NPV calculations takes into account the risk of respective projects. Should the firm accept Project X or Project Y? And explain. What is NPV? Net present value is the difference between the present value of cash inflows and the present value of cash outflows over a period of time. NPV is used in the capital budgeting and investment planning to analyze the profitability of a projected investment or project.
Good afternoon, everyone. All right, so to be mutually exclusive means that out of the set of possible projects, only one project can be selected. Given two mutually exclusive projects, the company can accept one of the projects or reject both projects, but cannot accept both projects. Now, Project X should be chosen over Project Y. Why? Because it has a higher net present value, 3.5 million versus 2.5 million. Since risk has already been considered, the project with the higher risk would have the higher rate of return, and in this case, it's Project X. This concludes our presentation for the evening. Thank you.
Thank you.
Thank you, Vanessa and Sarah. As usual, I'll just put my take on the question. So, Project X, very risky, NPV 3 million. Project Y, very safe, NPV 2.5 million. Now, the NPV takes into account the riskiness of the project. So, Project X, which is very risky, will have a very high discount rate. And Project Y, which is very safe, will have a low discount rate. So, the cash flows of Project X will be much more heavily discounted than those of Project Y. So, the fact that Project X still has a higher NPV than Project Y means that Project X is a more attractive project for us. So as such, we are going to choose the project with a higher NPV. The projects are mutually exclusive, else we'd want to do both, because 2.5 million is also very attractive. But they are mutually exclusive, so we choose one. We choose a higher NPV. We choose Project X. Alright, all the best, guys. Talk soon.